to our webinar on affordability under pressure, challenges across the food supply chain, brought to you by CFAIR, the Council on Food, Agricultural, and Resource Economics. My name is Jane Kolodinsky, and I'm the CFAIR Program Chair. It's my pleasure to be moderating today's webinar, and welcome everyone. Next slide. It's CFAIR's mission to translate high-level research and knowledge to a diverse audience that includes policymakers, elected officials, and federal administrators. When we demonstrate the value of our profession to these groups, the Council increases public appreciation for research, extension, outreach, and academic programs in agricultural and applied economics. Next slide. Before we get started, I'd like to provide some background on today's topic. Affordability continues to be one of the biggest challenges facing stakeholders across the food and agricultural supply chain. Farmers are grappling with rising input costs for essentials like fertilizer and fuel, while distributors, retailers, and consumers continue to feel the strain of persistent inflation and economic uncertainty. These pressures are reshaping purchase decisions, consumption patterns, and confidence in the economy at every level. In today's webinar, we will explore how inflation, economic shocks, and shifting consumer behavior are impacting consumers, businesses, and households alike. Next slide. CFAIR has assembled a panel of experts to discuss their work, starting with Michael Langomere. Michael is the director of the Center for Commercial Agriculture in the Department of Agricultural Economics at Purdue University. In addition to being one of the principal investigators for the Purdue University CME Group Ag Economy Barometer, a nationwide monthly sentiment survey of U.S. farmers, Michael's program areas include agricultural finance, costs of production, and transition planning. Eric Velasco is professor at Montana State University. His primary research interests are in agricultural marketing and applied econometrics. Much of his research focuses on characterizing variability in cattle profits, production, and marketing. This work has also led to complementary research exploring the application of econometric methods to a broad range of issues, including censoring within systems of equations and the identification of heterogeneity. Next slide. Dr. David L. Ortega is a professor and the Noel W. Stuckman Chair in Food Economics and Policy at Michigan State University. His research examines how consumers, producers, and agribusinesses make decisions within food systems with a focus on food price inflation, agricultural trade, consumer demand, and agri-food supply chains. His work draws on more than 15 years of international field experience. Before I hand things over to our panelists, I'd like to remind you that you can submit questions for the speakers in the chat box at any time. We'll hold a Q&A session at the end of the presentation where our panelists can address your questions and maybe even banter back and forth a little bit. I'll now hand the webinar over to Michael, who will start us off.
Next slide, please. When I'm talking about farm production cost, I always like to start with this slide because it's really simple to understand exactly what the impact has been from inflation since essentially COVID. And in this chart, you can see that in 2021, the farm break-even price for high productivity ground, that's ground with a corn yield of 230 bushel in Indiana, was about $4. A year later, and ever since then, that break-even price has been $5 or more. And so essentially, we've seen a 25% increase in production cost since 2021. And if you look at the USDA NASS production items input price index, it increased about 10% in 2021 and about 17% in 2022. There actually was a fairly large increase in 2025 of 9%, but a large portion of that increase was related to feeder feeder animals, particularly feeder cattle. And so a lot of the crop inputs did not increase all that much in 2025. And so this is where we were at before the Iran conflict. We were looking at a break-even price around $5. With the increase in nitrogen and the increase in diesel prices, we're looking at a break-even price that's about 25 cents higher than the $5.03. So the break-even price is closer to $5.30 if you had not bought your nitrogen or your fuel before the Iran conflict. Next slide, please. As part of the monthly Ag Economy Barometer, we've been asking this question ever since COVID. Looking ahead to next year, what is your biggest concern for your farming operation? And it's been the same answer every month. The percentages change a little bit, but it's been the same answer ever since COVID, and that's high input costs. Notice how strong that answer is compared to all the other items, including low prices. And so certainly input costs are a big concern of farms in the U.S. It's a bigger problem right now for crop producers, but when you ask the livestock producers in this survey which of these items is your biggest concern, livestock producers also point to high input costs, and again, they're feeder animals, if you're a feeder producer, are quite a bit higher than they're going up quite a bit from a year to year, from a year to year standpoint. And so certainly that input is very high. If you look at feed costs are actually quite a bit lower than what they were 3 years ago when corn and soybean prices were higher. Next slide, please. Of course, after the Iran conflict, we want to focus. We need to focus on two different prices in particular: nitrogen prices and diesel prices. I'm just going to show you a chart of anhydrous ammonia prices. The diesel prices would be even a larger increase since during the last 2 months. But you can see here on this chart using USDA data from the Illinois Production Cost Report. Cost Report's a biweekly report that anhydrous has increased rather dramatically in the last 2 months. And if you look at from May 25 to May 26, anhydrous is up 42%. Even though we haven't seen that big of increase in phosphorus and potash, since the start of the Iran conflict, they're also up quite a bit year to year. Phosphorus is up 13% and potash up 8%. And so certainly relatively high fertilizer costs are having a large impact on crop producers in 26. Next slide, please. In the Ag Economy Barometer, I want to share you three slides three slides related to the last month's release. The first question we ask related to the Iran conflict is just to figure out whether someone in the survey produced corn. It's about 74% of the producers produced corn. Next slide, please. And then we had a follow-up question: what impact do you think the Iran conflict will have on the break-even price for corn in 2026? And it's all over the board, as you can see here. But what's rather alarming to me is that right-hand column there. 37% thought the impact would be 10% or more. Now, part of this is going to depend on when they had bought nitrogen and other fertilizers, but particularly nitrogen. Certainly their cost of production is going to be higher if they bought most of their nitrogen after the Iran conflict compared to buying it before. In my back of the envelope calculations, I'm looking at about a 5% increase in break even related to higher nitrogen, higher diesel prices. Next slide. Another question that we asked in the Ag Economy Barometer that I wanted to share with you is this question right here. This gets at the skinny of the issue. What impact do you think the Iran conflict will have on your farm's net farm income in 2026? In the Ag Economy Barometer survey of 400 producers, about 1/3 of the producers are primarily livestock. The other 2/3 are primarily crop. That's very important. We're trying to understand the answer to this question. I would think the impact on livestock producers has been quite a bit smaller. And so I think a lot of the people that are saying very negative to negative are probably crop producers. Having said that, it's rather alarming to see that two-thirds of respondents say it's going to have a negative impact or a very negative impact. Next slide. To put into context what 26 looks like compared to recent years, I've got this slide here that looks at net farm income for a corn soybean rotation for a case farm in West Central Indiana. I use this a lot in my extension presentations just to look at trends in net returns. And you can see here, obviously, from 7 to 13, very strong net farm income per acre. Then we had that down period from 14 to 19 where the net returns were very low compared to the average. 21 and 22 were really good, even though we had higher input costs, higher input prices, a very strong surge on input prices during that period right after COVID. Net returns were good because the crop prices were really good. Corn and soybean prices really good. Input costs remained relatively high, and we saw the corn and soybean prices drop precipitously. And so in 24, 25, and 26, very, very low margins, even lower than what we saw during that 14 to 19 period. And so I'm going to stop there, and then I can address questions related to farm production costs in the question and answer session. Thank you.
Thank you, Michael. Next, we're going to move on to Eric. Welcome, Eric.
Hi, thank you so much. So I'm going to switch gears for just a minute to talk about the beef supply chain. And I think there is some overlap in what Dr. Lingmeyer was talking about. I guess one of the most striking things is, inputs have certainly gone up. And I think, in cattle production, that is definitely the case. But it's been overwhelmed by some of the prices that we are seeing. So, we're experiencing record high prices kind of across the supply chain. And so some of those higher input costs really haven't risen to the amount of concern that you'd probably see in some of the grain areas. Next slide, please. So just to summarize kind of what we're going to be looking at, first point is just beef prices are historically high, and we'll compare it to other protein sources and get into some of the supply chain pressures that are really causing this. I'd say one of the unique things that kind of links Dr. Lingmeyer's presentation with Dr. Ortega's later is just that the beef supply chain is going to have multiple players across, across that supply chain who are experiencing very different things right now. The cow-calf producer, say in Montana, is experiencing, a lot more profits than you see as you go further along the supply chain. So we're going to talk about why cattle prices remain elevated and what some of those supply constraints are, as well as some of the ways that firms are adjusting to some of those supply constraints, and then potentially how long those high prices will remain. Next slide, please. So here, just to kind of put it into context, beef in red, we see 100% ground beef prices, obviously at a record high right now. These are all in real terms, $20-$25. And I put this up because we do, see inflation around, 2020, 2021, where we see increases in all kind of protein sources, sort of across the board. But really, what we're seeing right now in beef is somewhat unique. You see pork and chicken prices both either falling or flat. So there's some unique aspects to the beef supply chain right now. And one thing to just keep in mind as we go forward is, we look at the cow-calf sector. That's a very inelastic supply. One of the confusing things is with prices so high, we would expect for production to be increasing. But with a cow-calf sector, with a very inelastic supply, really what that means is there's very little response into those higher prices. We'll talk about as it gets further downstream how firms are able to adapt to some of those higher prices and adjust production accordingly. Next slide, please. And so here, one of the primary reasons, if you see a cow-calf producer in Montana, they rely on forage, they rely on good rainfall, and they really do not want to see drought. And if you look at this chart, we just see going back to 2000, there are many years where you have over 50% of the, drought area in the U.S. as at least kind of a D0 classification. That's particularly the case since 2021. You really see, really a lot of up and down if you go before that, but really since 2021, you see a lot of very firm droughts coming into the US and hitting different areas. Next slide, please. To illustrate that, here's the drought monitor kind of for, in the bottom right, you'll see that's this year, which is probably the reddest, meaning the drought is the most intense. But if you looked at 2025, you had, more drought, more in the kind of the Southwest region. 2024 was a pretty good year, a little drought to speak of. But going to 2023, kind of the Southern Plains region, drought, obviously big cattle production region in that Kansas, Oklahoma, Texas region. And so you can see that drought kind of moving, to different places, kind of prevents some of this rebuilding that we've been kind of waiting for, for cow-calf producers to really rebuild inventory levels. Next slide, please. And just to demonstrate, when I say inventories here, that's the orange line there. You can see we have a bit of a inverse relationship between, and I chose calf prices because they are the most sensitive to those changes in inventory. So typically when you see that inventory high, you're going to see prices low and vice versa. So right now we've seen kind of, I guess, two things you can point to. One is a long-term trend going downward in cattle inventories, really since the mid 70s. There are some long-term reasons we expect that to continue. But then there's also those fluctuations, those cyclical fluctuations that cause inventories to drop below normal and above normal. Next slide, please. And one of those main reasons is just this biological lag, often referred to as the cattle cycle. Here I'm looking at Montana just because it's maybe a little bit easier to identify it with a smaller region. But basically, you get to this area where you have low inventories. Remember, that correlates with high prices, gives producers signals to produce more, but there's a 2-year lag. So a lot of times there's going to be too much rebuilding. And then by the time you get 2 years out, that price is going to be low, and then you're going to see the correction in the other way. So we generally see these around 10 or so years. I think if you look nationally, you probably saw another cattle cycle begin around 2015 is kind of what they put that in. We didn't really experience that here in Montana. But generally, 10 to 15 years is kind of what we expect of that cattle cycle. Next slide, please. So cattle cycle is fairly normal. I guess what I would say that is not normal is the margins between feeder and fed cattle. So right now we see this, the blue line feeder. Think of those as your lighter animals, the animals coming out of cow-calf operations, and then fed futures. So those are our heavier animals going into feedlots, coming out of feedlots. And so that margin tells us a bit about where the price signals are going. What this high feeder fed price ratio tells us is really there's a lot of signal for cow-calf producers to increase production. And we see it's almost 50% higher, which is unheard of. 2015 was kind of a high water mark. It got about to 40%. Now we're at 50%. So a lot of those signals going back to the cow-calf producers to produce more. And as we mentioned earlier, pretty inelastic supply. So cow-calf producers aren't really able to make those modifications to production. What we're going to talk about next is how some of the downstream producers have made some adjustments. Next slide, please. So the first supply response that has been frankly pretty dramatic is just we're seeing more weight on animals. And so you look at this is the dressed weight going into federally inspected facilities. You can see it was pretty flat from 2017 to 2023. And we go from about 830 pounds and we're at 900 pounds in 2026. So we're talking 70 pounds of increase. And so that's more days on feed at a feedlot, feeding animals out a little bit longer. They're coming in a little bit older. They're putting on weight. And so that again is a way for processors, feedlot operators to make some kind of adjustments that cow-calf operators can't really do. So putting more weight on animals, taking advantage of some new technologies, and feeding them out a little bit more. A lot of times that meat's going to include a little bit more fat. But again, I think the economic incentives are there to put on more weight. So that's one way. Next slide, please. The other way we've seen retailers really adapt is through more imports. And so we can look at this trade surplus. Imports really starting in 2023 have grown quite a bit. And we've seen this continue on. Again, it's another way for retailers to ensure stable supplies to consumers. When you have lower domestic volumes, you're going to get them from other places. Not just to ensure the same level of production, but also to keep prices manageable. Next slide, please. And just one kind of notable thing I think that I'll point out here is a lot of the increase so far in 26 and really in 2025 are imports from Brazil. And I think if you look at some of the South American countries as well, a lot more imports coming from those countries. Next slide. And just a quick take on exports. Exports hasn't really changed too much, so I won't spend too much time on that. Next slide, please. Okay, so now to get to how long are prices going to stay up like this? That was one of the things that Dr. Langmeyer said that people were concerned about. And if you're a rancher, you probably should be concerned about when prices are coming down. This is the most recent 2034 projection from the USDA. As you can see, that blue line, there's still an expectation of cattle prices kind of slowly coming down over the next 3 to 5 years. And I think that's consistent with what we see in the futures market, kind of slow decreases as you go out further and further. Next slide. And again, just as we see production come back, prices drop a little bit, we would expect to see some of those imports that I mentioned. Remember, those are capturing some of that gap to those to also diminish as well. So next slide, please. Just some final thoughts here as I sum up. And this is definitely thinking about the incentives economically for the cow-calf operator. Why haven't we seen the supply response? There's a lot of pressure to use rangeland for other things, to use them for crop production. In Montana, we see a lot for recreation and for development. So there's a lot of pressures kind of moving ranching out of that production system. Obviously, drought risk and recovery are an important aspect. Down the supply chain, we can see heavier cows and higher productivity. So in some ways, we're managing our overall amount of beef we're giving to consumers without more animals. And a lot of that is just because of the inelastic supply. Last slide. And that's all I have. I'm happy to take any questions as we get into the next section. Thank you very much.
Thank you, Eric. Now we're going to move down the supply chain and we're going to have David talk about consumers and others, but looking at consumer prices as we move down the supply chain. Welcome, David.
Great. Thanks so much, Jane. And yeah, good afternoon, everybody. Really excited to join this panel and take the conversation now to look at inflation and affordability from the consumer lens. So next slide, please. So the main takeaways from my portion here, I'll put them up front and then I'll spend the next 10 minutes or so making the case for these, is that food price inflation has really been driven by a convergence of factors that have impacted both the supply, but also the demand for food. So it's not just one factor or one shock that's driving food prices up. It's really this convergence of factors, and very problematic for consumers and others along the food supply chain is that once food prices rise, they rarely come down. And when they do, it's very short-lived. And so I'll show you some examples of that historically and also much more recently. We're also seeing high food prices affect not just consumer sentiment, but also consumer food shopping and food choice behavior. And once again, to the issue of affordability, we're seeing that price increases, not just in food, but even broader, are again starting to outpace wage increases, which is really putting a squeeze on affordability. So next slide, please. Now, when we talk about food price inflation, this is a topic I don't have to tell any of you joining in that has gotten a lot of attention, but it also generates a lot of confusion. So I'd like to really just sort of start off with defining what inflation captures and sort of where that confusion comes in. Inflation is the rate of change in prices over a period of time, and typically that's an increase in prices. And that's very different from the price level. So prices and the price level is where we currently are. Now, when inflation cools or when inflation comes down, that doesn't mean that prices come down. It just means that they're not increasing as quickly. And that distinction really matters to both how households, but also how policymakers respond to these increasing prices and how consumers interpret a lot of the economic data that they're receiving through the news and other channels. And so I'm going to show you a quick illustration of this concept. So if we can go to the next slide and also play that animation. So as this is playing, you can see that the inflation rate for food is on the left, on the orange, and then the price level is on the right. And that goes from 2019 to present, the latest data that we have in April. So you can see that food inflation really peaked in August of 2022, where we're looking at double-digit increases in food prices, and it has largely moderated to where we're currently at 3.2% increase, and that's year over year. So currently, food prices are 3.2% higher today than they were a year ago. Now, that rate of increase, which is what inflation captures, has come down, but you can see on the right-hand side, on the blue there, that the price level has remained high and keeps increasing. So that's sort of a key distinction that I think is very important to keep in mind, is that the inflation rate is very different from the price level. So decreasing inflation does not mean decreasing prices. So if we can go to the next slide. So what consumers are really reacting to here are the cumulative effects of inflation. So when we look at the past 6 years or so, food prices have increased more than 33%. And that's a pretty notable increase. And a lot of that really happened in the summer of 2022, when we were looking at those double-digit increases in food prices, which was a rate of food price inflation that we hadn't seen in a generation, in 40 years. And so this is really a permanent shift. It's not transitory. The annual rate of inflation has cooled, although we're starting to see that increase again, but that doesn't mean that prices are coming down. So food prices tend to rise over time. And in fact, that's actually a good thing, as long as those price increases are moderate. And as I'll show a little bit later, food prices rarely come down. And when they do, that's, for a very brief period of time. And so what households are really reacting to here, they're really adjusting to this new baseline where price and the price level are really significantly higher than they were just a few years ago. And this is exactly what people feel. So there's a lot of focus on inflation and the rate of inflation coming down, but really what matters to consumers is the price level. And that's a pretty significantly higher price level today than it was just a few years ago. So if we can go to the next slide. Now, food price inflation is not all the same. So we heard from Eric a few minutes ago. He was talking a lot about beef prices. They are at record high right now, but price increases look very different across various categories. Now, there are some similarities you can see here. I know that these are very small, but there was a spike in the rate of increase for many of these products in the summer of 2022. And that was sort of following a lot of the supply chain issues from COVID. You had Russia's invasion of Ukraine in 2022, the start of the bird flu outbreak that drove egg prices. They've been through a bit of a roller coaster ride, but we've also had pretty significant consumer spending on food. So when we look at the post-COVID period, especially after the reopening of a lot of state economies, consumer spending on food has been significantly higher post-COVID compared to right before COVID, even when you adjust for inflation. And so you have a lot of these supply shocks on top of increased consumer spending on food, and that's just a recipe for prices to go up. So there's been sort of a convergence of factors here. Climate events, so drought that we heard from Eric on the beef supply chain has certainly been one of them. But I want to focus a little bit more on some of the more recent shocks and factors that we've been experiencing. So if we can go to the next slide, please. One of those more recent shocks or drivers of food price inflation has been the tariffs and our approach to trade policy over the past almost 2 years now. So we saw last year the largest tariff increase in almost 100 years. And tariffs are simply a tax on the value of imported goods. Now, there are different tariff authorities, and so we've seen some of those tariffs been struck down by the Supreme Court. Those were the IEEPA tariffs, the reciprocal tariffs, but there are other tariff authorities that are being currently used to sort of re-engineer some of those original tariffs that we saw last year. That leads to retaliation, as we saw with the events of last summer, with China retaliating and also switching some of their buying and sourcing of things like soybeans to some of our competitors in South America. But one point that I think it's worth driving home is that the amount of uncertainty surrounding trade policy and the tariffs in and of itself is very costly. It creates that uncertainty, leads to a lot of companies, a lot of agribusinesses having to come up with contingency plans. There's an ever-changing landscape, and that has an impact on investments, sourcing strategies, which all raise prices and ultimately trickle down to the consumer in the form of higher grocery prices. If we can go to the next slide. While I'm talking about trade policy uncertainty, it also has an impact on our agricultural trade. So we have the latest data on agricultural trade for 2025. We see that the agricultural trade deficit has continued to increase. So we've been running a deficit for the past 4 years. And you can see here that both exports and imports took a hit, but our exports have actually decreased much more than on imports in 2025. A lot of that has to do with our exports being flat for a period of time, especially in the last decade when we were looking at the impacts of that first trade war with China. But we are seeing some of the impacts of the recent trade actions from last year showing up on the trade data, and that's impacting both our exports and our imports of agricultural products. If we can go to the next slide, please. Another factor in shock that's worth sort of noting here are the impacts of the conflict in the Middle East and what that's doing to the agri-food supply chain. This is really a major oil and energy shock. And the way that it really impacts food prices is through a couple of mechanisms, but the most direct one is through higher fuel prices. So we've seen the price of oil break $100 a barrel on a number of occasions, but what really matters here are the refined products. So diesel in particular is very important. It's how food moves, all the way from farm distribution and how it ends up at the grocery store. And we've seen diesel prices, be significantly elevated, over $5 a gallon. And it really impacts the more perishable food products the most, products that have to travel longer distances to reach consumers. But that's not the only pathway. As we heard from Michael earlier in the webinar, this is having a pretty notable impact on nitrogen fertilizer, phosphorus fertilizer, and those concerns from producers that we were talking about earlier in the webinar are real, but it's something that we're not going to feel on the consumer end until next year or even beyond that, because it has to sort of work its way through production and really there's a pretty notable lag between when we have these shocks and when they show up in the form of higher prices. So it could be the better part of 6 months, if not more, before we see the full impacts of this conflict show up in our grocery bills. It's worth pointing out that this is very different from the other geopolitical conflict that started in 2022, that was Russia's invasion of Ukraine. And that was because back in 2022, we were looking at both an energy shock, but also a supply shock to a lot of agricultural commodities. And that's not the case here. So we're really just looking at the impacts to higher oil prices as well as fertilizer, because the Gulf region in the Middle East, they are not a major agricultural supplier or producer. In fact, many of them are net importers of agricultural goods. So if we can go to the next slide. And the reason why some of these shocks and a lot of the factors that we've talked about are so concerning, and even some of these policies, is because once food prices increase, they very rarely come down. So I've sort of plotted food price inflation going back to the early 1900s, and you can see that since the turn of the century, we've only had 2 periods where food prices decreased, and they were very short-lived. So the nature of prices is that they're downward sticky. Once they go up, they very seldom come down, and when they do, it's very short-lived. And so it's if we can go to the next slide, it's these high prices which are really affecting consumer sentiment and consumer behavior. We just received the latest reading from the University of Michigan Survey of Consumers that tracks consumer sentiment, and it's reached an all-time low ever since data recording started. So we're looking at an all-time low in terms of consumer sentiment. A lot of that is driven in part by high prices for things like gas. Food is also playing a role. And it's also turning and translating into changes in consumer behavior. Consumers are trading down, they're being much more value oriented, they're making much more frequent trips to the grocery store, doing a lot more price comparisons. So these high prices are really impacting consumers. If we can go to the next slide. And so I've just argued that once prices increase, they very seldom come down. So the natural question here is, well, how do we recover from an inflationary episode? And so the answer to that question is that wages have to catch up. And so if we can play the animation here, I've sort of benchmarked this to 2020. And you can see that for a period of time there, especially in 2022, food price increases were outpacing wage increases. And that's really that affordability squeeze that a lot of us felt and a lot of consumers felt at the grocery store. Up until recently, wages had, wage increases were actually catching up to price increases. But we've received some recent data that shows that now wage increases, or price increases, I should say, are again outpacing wage increases. And so if we can go to the next slide to sort of wrap things up, I want to show you some data that's coming out of USDA, the Economic Research Service. That's the food price outlook for the rest of the year. It's a great resource. The Department of Ag and the Economic Research Service have a lot of information on food prices. You can see here that they are forecasting food prices to increase 3.4% this year, with grocery prices, or what is known as food at home prices, increasing 3.2%. There's still a lot of uncertainty, but that's sort of the main outlook. And as you can see, a lot of that is driven by what we're expecting to see with meat prices, in particular beef prices that Eric talked about. And so there's still a lot of moving parts when it comes to food price inflation. And the next slide. And with that, look forward to taking your questions and the discussion that we'll have, but also feel free to reach out to me at my email or on LinkedIn.
Thank you, David.